Okay, Stephen Parker is here, head of thematic equity solutions at JP Morgan Private Bank. Liz Young is also here, director of market strategy at BNY Mellon Investment Management. And of course, our guest host, Savita Subramanian, is here, head of U.S. equity and quantitative strategy at Bank of America Merrill Lynch. Guy Adami is here. Leisman's hanging out. We got everybody here. I'm going to go to both of you real quick, which is you have the bond market flashing lights and sirens and the whole situation. The equity market, I don't know.
Doesn't care.
Doesn't seem to care. What gives?
The equity market cares intraday, right? But then we close and it doesn't seem to care. I think you have to watch the signals. So the market watches the inversion signal at the 3-month 10-year and gets scared when that happens. And that definitely has happened. So then we see some of this gyration intraday. The recession signal, however, is 2-year 10-year. And as we all well know, we've had inversions without recessions, but we've never really had a recession without a preceding inversion. So the recession signal hasn't happened yet. We don't think there's a recession on the horizon. And at this point, it still makes sense to own stocks at this dividend yield above the 10-year.
By the way, Leisman, what do you think? As a signal, is it a real signal? We were talking about this in the last hour.
I don't believe any single market has perfect prescience or perfect vision into the future. What's the word I'm looking for? The accuracy that we impart to somewhat randomly divined numbers in the market is beyond me. It happens. It's not perfect. What is the phrase that was coined? The market has predicted 9 of the last 5 recessions. Look, if you got something that's better than 50%, you may want to go with it, but, it's not perfect.
Stephen?
I'd also think that you have to keep in mind the buyers in the fixed income market, especially treasuries and agencies, are not as price sensitive as they have been historically. It's central banks who now own 50+% of the market. And so, I think that's certainly skewing some of the price movements that we're seeing. And I think equity markets are reacting to that. I mean, when you look at what people are buying, the shift this year has been into defensives, bond proxies, investors looking for yield anywhere. There's been $5 billion into ETFs in the traditional defensive sectors. $20 billion has come out of cyclical sectors. So equity market investors are clearly voting in response to the bond market.
But what do you think of the valuations in those defensive sectors at this point?
We're cautious on them. I think that you're
we're seeing a potential, I don't want to say bubble because we're not there yet, but we're seeing inflated valuations for those sectors.
I think there's a low volatility bubble right now. Mm-hmm. I mean, if you look at any stock with low volatility, it's trading at in the stratosphere. But to your point about tools for forecasting recessions, so one of the things we came up with was the necessary and sufficient conditions for a bear market. And there are 19 things that generally happen. I'm not going to go through all of them, but there are, credit spreads, tightening of lending standards, et cetera. And right now, less than half of those conditions have been checked off.
Fascinating. I'd like to see that.
Yeah, it's interesting. So
Malcolm Gladwell says there's 11 things that have to go wrong for a plane to crash.
there's 19 things that have to go wrong
and how many are we
the
in?
Market to break. 47% have been ticked off. So just less than half of them have been
That's pretty good.
Off.
That's a lot, though.
It's not bad. It's a lot, but typically before the end of a bull market, you've seen 80% or more triggered.
Liz, I want to ask you a question. First of all, would you be surprised to wake up one morning to hear the United States government is intervening to weaken the dollar? And what would happen to your thinking about the stock market if that were to happen?
I would be surprised if they could actually do it effectively for a long period of time. I think they could send a message that we'd like to intervene and affect the currency. But I don't think they have enough tools to actually do it over a longer period that would be lasting and that would actually bake through into the economy. The market would react, certainly. And I think as we...
How? Is it a plus for stocks? There are people who argue that the president is essentially right here, and this is a subject for another day, which is that the dollar is overvalued and considerably overvalued. I mean, Mark Chandler walked me through a bunch of things. If you look at purchasing power parity, another day. But the dollar is overvalued, and that we would get some boost to stocks and earnings from a weaker dollar.
Which is why we're going after the Fed, or why the administration is going after the Fed, right? Because we want to put pressure on the dollar. But the issue is, I think at some point the Fed is going to have to take the market on and say, we're not going to keep cutting because we don't have any good reasons to keep cutting. We'll cut a little bit, and I think they got backed into a corner in July by the fact that we had 100% chance priced into the market that they would cut if they didn't do it.
Do you think it was a mistake for them now?
No, I don't think
Okay.
it was a mistake, because if they didn't do it,
Right.
financial conditions would have tightened to a point that they couldn't reverse. So they had to do it in July. I think they probably do one more this year. But at some point, maybe later this year or early next year, they're going to have to say, what gives? What's the data that's telling us we still need to cut? And they'll have to just stop.
So, Stephen, how do you game out if we got the headline, currency war, U.S. intervening in the currency market? How would stocks react?
Well, I think there would immediately be, a pickup in volatility. But I think one of the places you would look, if you were to actually see policy that could weaken the dollar, which to this point has been more of a hope than a reality, look for international markets. Look at emerging markets specifically. That's one area where we actually like the fundamentals. They've suffered a lot more pain as a result of the trade headlines than we have here in the U.S. Valuations are discounted, and that China stimulus from the beginning of the year should be kicking in now. If you started to see that dollar weakness, I think that's another tailwind for emerging markets, which makes for a compelling opportunity.
And commodities could do really well. Energy, which is like dirt cheap at this point, could be the sector to own in that environment.
If they were to actually intervene.
But if they didn't,
If they intervene, exactly. But I'm just saying, a weak dollar is not priced into the markets right now. If you look at the
a weaker dollar,
a weaker
stronger
dollar.
right. So that means that the market really thinks, it's hard to impart all this stuff, that if the Fed moves more, we expect Europe to move more, which means that gap that we've been talking about all week is going to remain there. I want to say one thing. I want to applaud the president for the following thing. For years, I've been complaining that the Treasury doesn't talk about the dollar. The dollar is too important, like a socioeconomic factor, to not discuss. We need to talk about it.
Just 2 minutes ago, you were saying that you liked when the Treasury.
I didn't say I liked that. I said that's what used to happen. I think we ought to talk about it because people are affected by it, and it's important. However,
but you want them to say publicly we want to devalue our own currency?
I think we ought to have a conversation about it, is my thing. Nobody would talk about it. It would just go on, and you'd ask. I've interviewed every Treasury Secretary going back to Brady, I guess, even, and they didn't talk about the dollar, but the dollar affects the way people live. It affects businesses. It affects everything. It's okay to have a public conversation about the dollar. What's not okay is I don't think the president can get there from here without allies.